Hello, hello. Happy Thursday afternoon, 7 p.m. Eastern Standard Time, right on time here. Currently 9 p.m. Eastern Standard Time down here in Brazil. We're going to go ahead and start in about 1 minute. Tonight's session, we're going to go through our JP trade from top to bottom. We're still in the trade, but we're going to talk through how we actually found it, how we charted it, how we found the contracts, and then lastly, how we actually managed the trade. We're going to start from the very beginning and go through the entire thing. Hopefully you guys get something out of this. We're also going to talk about duration versus momentum. And this can be kind of a foreign subject to a lot of traders, mostly because they've never been introduced to the idea of a duration versus momentum trade. But understanding how volatility can impact your trades can give you a better understanding of what types of contracts you want and also help you build expectations around the trade so that hopefully you can stay a little longer inside those trades. That is the overall key. So I'm going to go ahead and start here in about 2 seconds. Just got to drop some links really quick. All right, thanks for hanging out with me. Okay, let's go started. First things first, welcome. Thank you for showing up. Tonight we're going to go through the full deep dive of JP, how we found it, how we traded it, how we're currently managing it, show you the current profitability on it. I'm going to take you through a journey. We use a different type of trading style than most traders you're probably following. I'm going to give you a bird's eye view of how we look at the market. Maybe you take something away from it for yourself. And we're going to touch on a subject like I was just talking about, duration versus momentum, because this particular trade is not for everybody, as you're going to see in a second. So first things first, let's go through what makes our system special, how we were able to find something like a JP. If you put yourself back in the shoes of the general market participant back in November, December of last year, most people were looking at trading tech, which totally makes sense because tech was realistically tech, communications, and consumer discretionary. Those three areas of the market were really going bonkers, particularly in the small mid-cap land, right? So everybody was looking to buy the Apples, the Microsofts, the Teslas, the normal stuff. But what people didn't realize was that the financial sector was actually the best performing sector in Q3 and Q4 of 2023. Raise your hand if you knew that. Most people don't know that. And as a matter of fact, it caught us off guard as well when we started scanning through potential setups in November. What do we want to take? Well, look, financials are actually outperforming. We'll get through that part in a second, but what I'm trying to illustrate here is we build out this macro idea first, and then we whittle down to the actual stock. So I'm going to go through what a normal system looks like for most traders. I'm going to use a pyramid. It's going to look something like this. The most important part, the base of the trade, is the individual stock. This is how most people approach the market. And once again, I'm not saying there's anything bad about this. We just approach it differently. So I'm going to go ahead and show you really quick how they do it. They find the individual stock that they like first. They find the setup. Let's go ahead and rechange that too, because everyone's smarter than just looking for a setup. They look for the catalyst behind the move, because if you're above 5 years old, shapes on charts aren't necessarily an edge. You need gas in the car to make it go, right? So obviously a catalyst on the back end would probably help. Individual stock first, you scan through a particular setup, you find it, you use the catalyst as an opportunity to buy the actual trade, then you execute it. Everything is focused on the individual stock. So let's say, for example, you like to trade symmetrical triangle breakouts. Common. You would scan or somehow build a scanner to find this specific setup. And then obviously you're looking to buy the breakout, And like I said, if you're above the age of 5, you also want to validate that with some sort of catalyst. It doesn't have to be earnings, but something that shows you there's going to be an increased amount of people trading that stock, right? Relative volume, earnings, whatever you use. This is a typical bottom-up approach. Let's go ahead and type that out. This is how most people trade, whether you know or not. I spelled approach wrong, huh? Nothing wrong with that, but let me go ahead and show you how we do it. We use something called a top-down approach. The most important part of our system is not the individual stock. As a matter of fact, that's one of the least important parts. The most important part is the market environment. This matters more to us than the individual stock. Where in the market are financial institutions participating, either to the long side in a bull market or the short side in a bear market? That matters more to us than the specific individual stock, generally, because there's a higher probability chance of a sustained rally when there's financial institutions or just large players in the game focused on a specific portion of the market, whether it's sector, industry, market cap, theme, whatever you want to call it. Then from the market environment, we go and find the individual stock. So what we're looking for are the big fish in the pond. Where are they actively speculating, accumulating, distributing, whatever we're looking for at the time? Then we go and find a stock that will allow us to accurately express our thesis. In a bull market, we're going long. Then we have to execute the trade. It makes more sense to me personally, I've traded both ways, to trade the top-down approach, because statistically, if you're trading on the same side as the largest financial institutions, the buying power that can move these things is insane. I don't know about you guys, but I don't know too many individual traders or investors that can move a market. I do know, however, that financial institutions can. And therefore, we try to find traces of financial institution accumulation in a bull market, and then we want to participate as the breakout occurs, or distribution in a bear market, and obviously play the breakdown as that occurs. But it all starts with market environment for us. So take this, regardless of whether you're already trading the bottom-up approach or the top-down approach. Now you know there's another side of the equation. So the reason why I wanted to start with this was because if we look at JP Morgan, as a matter of fact, I'll pull the actual trade as we took it. So what you're about to see is our market research portal. This is our trade ideas tab, and one of our members, Dom, who helps us come up with a lot of these ideas. And this actually loads, if it loads. Circle's been a little slow today. See if it actually does. Try to refresh the page really quick. If not, we'll just do it from Trading View. I love this platform, but it really sucks sometimes when it goes down because it takes forever to come back up. So Circle, if you're listening to this, I'm a believer in your platform. Please do what you need to do to make this thing quicker. I guess the charts just don't want to load, so that's fine. We're going to go back to it just so you can see where we originally found it. We're looking at the all-time high breakout. See if I can zoom in a little bit here. Doesn't help a whole lot, but that's okay. You can see we're looking at the all-time high breakout. And the reason why this is important, we'll go back to trading, is obviously we're above the all-time high breakout. Now, most people have cognitive biases where they go, I don't want to buy something at an all-time high breakout. It's already at an all-time high. That is a bad bias to have. I'm telling you right now, from both experience and statistics, trends tend to trend longer than most people expect, and all-time highs give us an incredible opportunity to gauge risk. It's as easy as, if this is breakout and all-time highs, I probably want to be long, and if it's not, then maybe I want to stop out. It's a binary decision. The reason why I bring this up is we did not scan for JP Morgan and go, wow, this is an all-time high breakout. We should probably be focused on buying this. That's what a bottom-up approach would do. What we did instead is we focused on the market environment first. And I think that's important because as you see in the write-up, we had positively identified, and we took this about 2 months ago now. It still says a month ago, but it's about 2 months ago. Capitalizing on JP Morgan's positive momentum in the financial sector. That's the very first thing we noticed when we were writing up this trade idea. So when we go to Koyfin, which if this is your first time using Koyfin, this is a fantastic program. I do not get paid to shill it. It is paid. It does have a free version, but the paid version is worth it. If you're looking for an in-depth macro tool, I could not be a bigger fan of Koyfin. We're going to go through market dashboards, and we're going to look at U.S. sectors. I'm going to paint the picture here. Remember, we're using this top-down approach where we focus more on market environment than individual stock. If we look at the last 3 months, now this is going to cut off a little bit of the October and November dates, but if we look at the last 3 months, financials, which once again probably catches people off guard, is outperforming nearly everything. And up until today, it was everything. Industrials just took over a little bit. So put yourself back in October/November, right as the market started to pivot. We're pulling up sectors because we knew we wanted to get long, and we look at which sectors are outperforming, and it was financials. They were outperforming tech, which caught us off guard, caught everybody off guard, as a matter of fact. We didn't expect that. So then we started to ask ourselves, okay, once we find that there's strength in a sector of financials, going back to November, and it had shown strength since the beginning of the summer, which is super ironic because everybody was afraid of a regional banking crisis. Whole fiasco that never actually ended up playing out. I think 2 or 3 banks went insolvent, and financials are trying to press into all-time highs right now. We go all the way back to the XLF ETF itself. So this is your financial sector ETF. What we're looking for when we take these trades is not only relative strength, which is what we're finding here, but absolute strength on the actual chart itself. So if we're looking at the Koyfin and we're going financial sector is outperforming at that point over the last 3 to 4 months, the leader, we should probably look to find names that are breaking out along with the financial sector, but let's make sure the financial sector is not trapped underneath overhead supply. You're a basic technical trader, you understand that generally speaking, price wants to go in the path of least resistance. At least that's the easier trade. Absolutely. And at the time when we were looking at financials, we were already breaking above the 200-day moving average, which was something that really caught us off guard because once again, we didn't expect it. And a bullish momentum regime was just starting to form on the RSI. If you're not used to referring to the RSI as a momentum indicator, most people use it as a mean reversion indicator. You can use any sort of momentum indicator, RSI, MACD, etc. But the way that we use it, above the 50 RSI, oscillating below the 100 and above the 50 means that bulls are in control. So once again, top-down approach. We're focused on the financial sector back in the beginning of November. It's outperforming over the summer. We know we want to get long if the market's going to pivot, which we had accurately identified. XLF had broken above its 200-day moving average, and at the time, bulls appeared, I do want to point that out, it's easy in hindsight to call this out, but appeared at the time to have full control of the financial sector, and we were beginning to break above the 37 area. Now, we did break out in the middle of December, which gave us the green light to start looking at a lot of different financial names. If the sector ETF is breaking out on an absolute basis, and the sector ETF is outperforming on a relative basis, do you understand how there might be an actual play there that gives us a higher probability trade? We have a bunch of different confluences there, right? Everything's working in tandem. Once we realized that from a relative standpoint and an absolute standpoint, financials were somewhere we wanted to be long, we needed to go and build a scanner. But before the scanner, we needed to make sure where in the financial sector we wanted to be long. So if we go to Koyfin, we can actually go to something called factor analysis, size versus value. And if you go to the 3-month chart here, this is going to be a little wonky because there was some small mid-cap outperformance at the end of the year last year. But if you look at the factor analysis ratios of different market caps against the benchmark, which is the S&P 500, you can get a general feeling of where in the market money is flowing on a market cap standpoint. So once again, if we knew that money was flowing into the financial sector on a relative basis, it was flowing into the sector on an absolute basis, and at the time, everything was outperforming actually, other than, surprise, large cap growth was the underperformer then. If you were trading back then, by the way, an underperforming market cap does not mean it's going down. It just means it's going up less than the benchmark. So large cap growth underperformed large cap value at that time, which caught everybody off guard, including us. We didn't expect it, But thankfully, we had some exposure to it. Small mid-cap growth outperformed. Small and mid-cap value was outperforming. So we knew that at the time, financials were breaking out on an absolute and a relative basis. And there was essentially an opportunity to get long almost anything in the regional banking space, or not regional, excuse me, the financial space, including the regional banking space, which we did. It wasn't a huge win. Regional banks ended up fizzling out. Most trends do, by the way. We were able to get out for a minor win in regional banks, but what really took over were the large and mega caps. So once again, once you know where in the market cap you want to go, which at the time it was a free-for-all, anything in the financial sector was free game. We knew we wanted to get long. You have to go and build a scanner. So remember, top-down approach, market environment first. We had the pivot accurately called out. We knew the sector, which were financials. We also got a bunch of tech stuff. I'm sure you guys have seen previous webinars. We got long Meta, we got long Microsoft, we got long Uber, CrowdStrike. They were all ended up being fantastic trades. ARM probably our biggest trade on a percentage basis, up over 2,000% right now. But it wasn't just tech and growth stuff that we were focused on. We wanted to get a little bit of a piece of everything that was leading. So once we knew we wanted to get there, I'm going to show you really quick how to build a scanner for this type of stuff. And take this with a grain of salt. I want you guys to take what I'm showing you and tweak it to allow yourself to build something that fits your specific system. So what I'm showing you here is not necessarily the only way to do it. We knew that market cap didn't really matter a whole lot in financials at the time because everything was running. So from a market cap standpoint, we wanted to have the entire universe of financial stocks available to us. Next, we wanted to get rid of any ETFs. All right, so by getting rid of any ETFs, we don't have to worry about all of the crap that we didn't want to be trading. We wanted individual stocks because the XLF ETF was telling us that we wanted individual stocks. It was breaking out. So get rid of ETFs. Generally, what we like to do is we like to have a volume construct of at least 1 million shares per day. If I can find volume, because I just added a bunch of new things here. Where is it? Every time I try to find a volume, I can't find it now. I love you, FinViz, for adding all of these awesome things that I'm never going to use, but it totally ruined where everything is. Here we go. Average volume. So we're going to put it over 1 million. Sector, financial. And now we just whittled our universe down from like 9,500 possible trades to 169. So these are financial names with over 1 million average shares per day traded. If we had a specific industry we were looking to trade, you can go and find it. But at the time we didn't. We just knew we needed financial exposure. If you're trading options, even if you're not, it's probably smart to put optionable and shortable on because you know, even if you're not trading options, how important the options market is to the overall market flow now. And obviously, if you're going long, you want shorts available. Let the dummies short into uptrends. Let them. That is liquidity for you. So we always have optionable and shortable on. And then the secret that most people don't know about, right? 50-day highs. So from a universe of 9,500 fucking trades, we've whittled it down to 17 right now. Now, if you put ourselves back in the mindset of November, those 50-day high lists in the financial sector were only showing the market leaders. Why? Because we had just come off of a 10% correction in the market over 3 months. So the 50-day highs are obviously going to be the market leaders that are already breaking out. What you can do here by clicking charts, this is what we do inside of TTI all the time. You can run through hundreds of charts relatively quickly, particularly if you know what type of setup you're looking for. So what we do, and obviously what we did then, was we pulled this particular scan up. You can use 50-day highs. You can use 0 to 5% below the highs, which is another one. So 50-day highs are generally going to be looking for names that are already breaking out and potentially looking to pull back. So you'd be buying pullbacks. If you go to something like a 0 to 5% below the high, you're looking for names that are pressing up into overhead resistance that have yet to break out. Therefore, you can front run them by the breakout. You approach them differently. But we're going to stick with the 50-day highs list. And as you can see, most stocks here are up and to the right for a reason. These are probably going to be most of the market leaders because 50-day highs list generally has a bunch of strong stocks in it. But what we're looking for, particularly in TTI, are horizontal level breaks. We don't need to reinvent the wheel here. We're just looking for overhead resistance area breakouts. Easy setups. Lo and behold, JP Morgan's on here. Didn't expect that. But we found JP Morgan. We found a couple of them. I'll go through one other one really quick at the end of this. But JP Morgan, we found it. And so once we know where we want to be long based off of the market environment, we go and scan for the individual stock that we think is best going to be able to express our thesis of being long financials. You think about JP Morgan, it's a bellwether stock. It's a bastion of the financial sector. It has a very high correlation to the overall S&P 500 movement. It made sense to us to want to get long JP Morgan as a cornerstone trade in our portfolio because guess what? When we go back to TradingView, at the time, it was breaking out into all-time highs. So once again, we're sitting there asking ourselves, financials, what's the best stock that we could possibly use to express this idea? JP Morgan. It was the only major bank that didn't suck. Look at Bank of America. You're going to see a lot of old charts here because we did our homework and we successfully, by the way, for anybody in TTI watching this, good job. We successfully bought the right one. Bank of America, obviously you can tell the difference in chart patterns. This is basically no man's land for TTI. Wells Fargo, we did take an opportunity on, as you can see. Citibank or Citigroup. See, we charted through all of these back at the end of November, or excuse me, end of December. There's a bunch of them. But once again, if you're in TTI or if you're watching this, I implore you, build a basket of stocks that will allow you to express your thesis and then buy the best stock in that basket. They are not all the same. So from a chart standpoint, you have a very simple decision. We had a very simple decision back in late December, early January. Do we want to buy something that has yet to prove itself as a leader? For example, Citigroup. For example, Bank of America. For example, Wells Fargo. Or do we want to own something that was already showing us leadership qualities? We made the decision to buy the market leader that was already showing leadership qualities. There's a reason why the market was buying JP Morgan before it was buying everything else, and it's not up for us to decide why. It's up for us as technical traders to identify it and take advantage of it. I think that's a big problem with most traders nowadays in particular because of social media and discords, and there's this incessant want of needing to know why everything is happening. If 14 years have taught me anything in the market, it's the fact that by the time you, Mr. Nobody, including myself, understands why something is happening, a majority of the alpha is probably gone on the trade. You don't need to know why things are happening, but you should justify the trade. And if you're a technical trader, it's off price. So JP Morgan, once again, showing leadership qualities at the time we were looking through all the different bank stocks, and we decided to buy JP Morgan. Now, caveat, we also bought KKR. It's around the exact same time. What is the difference in the setup between JP Morgan and KKR? Really nothing. They were both all-time high large cap breakouts. The one difference between the two, this is an investment managing company. JP Morgan is a major banking company. This gave us exposure into the financial sector through two different industry groups at all-time high. Not bad. It's actually pretty goddamn good. We nailed this. I'm very excited for us. This is a big trade for us. This is up 200 and something percent. And then the JP Morgan is up right now in between 120 to 150%, depending on where we entered it. Mine's up about 130, I believe, today. So let's go back to JP Morgan and let's talk through this idea of where we entered and how we did. Let's actually pull up the actual trade idea. Don't take my word for it. You can just read through the entire thing here. So we said risk on above 172, and our stop is below 165. And I get this question all the time. So take profits at 200, 215, etc. We used the June 1st 190 calls. That was our vehicle. We didn't want to pay any more than $3 for them. And they're up. This is a free trade, right? But let's talk through this thought process here. 172 and 165. We want to be long 172, and we want to stop out below 165. I don't know if this is how it's set up, but I think this was set up talking to somebody else. But let's run it exactly how it's written up. 172. We want to be out below 165. This is a 6-to-1 setup from a shares standpoint. It's the price target. 15, have it up at 213. Close enough. It's actually a little bit more than that, but we'll pretend it's 6-1. 6-1 setup. So for every $1 you're risking, you're looking to gain 6. Now, the question I get all the time, because some people took this trade and then stopped themselves out, and I'm going to give you guys one of, if not the most important lesson from tonight. As a swing trader, I don't care what you're doing intraday. It has nothing to do with me. So if you're a day trader or a scalper, you don't have to listen to this. But I'll tell you, there is edge as a swing trader of not closing your trade until the candle closes, meaning within the last 5 minutes of the day. If you can, some people can't due to scheduling. I get it. If you can wait to close at the end of the day, you will find many trades you take will have a wick through the stop loss and then a full recovery. These are called, and this is a normal market function, whipsaws. I'm sure everyone's heard that word before. And they suck, and you will never be able to get rid of them entirely. You will be a victim at some point. We call it the cost of doing business. I'm not going to write all that out, but you get it. Cost of doing business is one of them. There's no way to completely avoid it. One way to get around them is to not stop out until the candle is going to close. And the reason why I bring this up, JP Morgan gapped down after a great earnings report. And I'm not here to talk shit about anybody whatsoever. But of course, I'm public with the positions that we take, and I'm confident with the positions we take. I'm so confident that I have no problem losing and telling people that I lose. It just doesn't matter to me. It's a numbers game. The day JP Morgan released its earnings, it gapped up into all-time highs. I was ecstatic. Why wouldn't I? We had just grabbed an all-time high major bank breakout, and then look what happened the very next day, or that day, not the very next day. The very same day, we reversed to the downside, and those contracts got destroyed. They got destroyed. And then the very next day, we gapped down. Now, what's your initial gut feeling when something gaps down after having a really bad day already? Your initial reaction is close it, get whatever I can get, and move on. But I'm going to tell you right now, as a technical trader, you have a stop on the books, hopefully for a reason, a technical reason. Either it's a support level or it's to define your risk to reward. Something is telling you that you should stop at a specific level. If you do not adhere to that rule, you are going to consistently lose and never be able to figure out why, because you will have no data set to tell you what's going wrong. I'll tell you, most of you probably suffer from this, indiscriminately stopping out of a losing trade. Losing trades happen. In TTI, we lose nearly 50% of the time. The fact that we can lose 50% of the time and still make money over time is because we are targeting 6-1 setups. It's insanely high. You do not have to win many trades when you're focused on higher risk reward trades. 6-1 setup, I believe the break-even win rate is 15%. Meaning if you lose 15, or if you win 15% of your trades and you're only targeting 6-1, you're going to be break even, which means you can lose 85% of your trades. Anyway, most people don't care about numbers. This webinar is not about numbers, but I will talk about the fact that some people took this trade with us and they stopped out on the gap down. And the worst part was trying to talk to people about why did they stop out. And I'm sure you guys can probably infer, well, because my contracts were down a lot. I'm telling you guys right now, if you're utilizing options contracts to capture price movement on a chart and you're worried about the percentage on the contract, you're playing baseball with a fucking football, or you're trying to dribble with a goddamn baseball. It doesn't make sense. If your trading strategy is built on a chart and you're utilizing an options contract to figure it out and capture it, it is not a one-to-one move. There is no reason to freak out over a contract that is down more than the actual price on the chart. That's why stop outs count. Put a stop on the chart that invalidates the idea. Don't stop out until the candle closes in that area. In this case, JP Morgan gapped down. Of course, I'm human. My balls were in my throat. I'm thinking to myself, fuck. I'm 1.75 R into this trade. For those of you that don't know, if your 1 R position is 10 grand, I put 17,500 in it. If my 1 R is 100 grand, I put 175,000. What does that mean? I'm overweight JP Morgan. So of course the gap down scared the shit out of me. But this trade, just like every other one, will be managed at the close. And it didn't get closed. As a matter of fact, it rallied hard. And here we are like 6 weeks later, And by the way, I still have some people in the DMs when I announced that we were going to have this webinar. There's people in my DMs saying, like, I'm one of the guys that closed out of this. How can I do to get back in it? That's an incredibly challenging question itself. We're not going to get into that right now, but hopefully for those of you that did take this and get stopped out, you see me rant all the time. Don't close until the candlestick closes outside of the stop. Take it to heart. It's not always going to work, but most of the time it will. And over a large sample size, you will remain in good trades. So JP Morgan, after this, was pretty straightforward. Pretty normal trade, if you will. Slowly grinding up higher until it finally gave us about 100% close here. Now, if you're unaware of how we manage our winners inside of TTI and how we're able to hold these things forever, is at 100% profit, we close one half of the trade. Do the math, right? You buy 6 contracts, you're up 100%, you sell 3. The remaining 3 are risk-free. You're playing with house money. Think of it like you were walking around in Vegas, you see a roulette table, you throw your $200 on red, you hit red, you get $400, you put the original $200 back in your pocket, and you go, I'm only going to play with the $200 that I just won. That is what we are doing on every single trade. Every single trade, we are playing with house money. That is the first goal. So for most new TTI traders, they don't understand, how can you guys not take profit at 50%, 75%? These things are great. We don't take anything off until 100%. Unless the trade is just dead in the water and we still somehow have some profit, which sometimes does happen. I'd say probably 1 in 50 trades will close early for some weird reason. Market's weird sometimes. But we prioritize the 100% profit we close half rule. And what that allows us to do is, as long as we're not within 20 days of expiration, which is a different story, but we don't want to hold swing trades in towards that DTE window because theta starts to crush them, right? We close half at 100%, and that gives us the other half completely free. That allows us to hold this JP Morgan trade. We have June's, another 3 months with nothing risked on our account. We can let this thing continue to roll all the way to the price target. We can chip some off when it gets really big. But the best part is we have the luxury of not having to stress about it. We don't have to sit there and constantly worry about this trade losing anymore, because if it loses, it's just a break-even trade at that point. There's no problem. Now, you still have unrealized profits, and we don't want unrealized profits to just evaporate into nothing, especially if you have a problem with that. But the goal here is to try to turn trades free as fast as possible, so we have the luxury of allowing them the opportunity to move to the price target without us having to actively manage them every day. So once again, we're up in JP Morgan. I'm going to show Brian's trade here. Brian's one of our traders. He's on his second year inside of TTI. He has the June 21st, 2024. As you can see at the time, they're up a little bit more than this right now, but he was able to close half of his position at 124%. So by the way, if you do the math on this, 124%, you're not only getting it for the second half free, but you're banking profit. So now no matter what happens to JP Morgan, this particular trade is going to be in profit, not even break even. So he closed half at 124%. He has the other half to continue to ride. And obviously he's not the only one, but this is the one that I've been showing on social media. So there we go. And he says, like, GTC order closed or got filled, closed 50% on one account. I'm still holding full size on the other account since I de-risked to January and February. And at the time he was holding cash. So once again, this is the power of being able to close half and how we're manage these specific trades. Now let's talk about a concept about JP Morgan in general. This is not a trade for everybody. And I'm sure for some of you guys, this is probably a fucking boring trade. I'm going to tell you really quick though, making money is not boring. If you're addicted to trading and not making money, you'll find a way to trade everything. And I don't need to be the one to tell you that that's a really fucking stupid idea to do, right? If the goal is to make money, find the setup, groups of stocks, whatever you need to do to make money. Trading should not be entertainment. It should be an income builder. The reason why I bring this up is JP Morgan has been on our books since the beginning of January. It is now the beginning of March. So we're 2 months into a trade and it's only up 120 something percent. That is directly related to a concept we're going to talk about really quick called duration versus momentum. Now, this matters a lot, but particularly to different account sizes. And let me extrapolate that out. Doesn't matter what account size you have. You can trade both duration and momentum. No problem. But I'm going to ask you something. JP Morgan, we had an idea that this was going to move 25%. That's our profit target from the all-time high break-ish towards the 220 or 215-ish. It's about a 25% move. You don't need to understand volatility perfectly. It's a big thing inside of TTI because it helps us build expectations. But this indicator here, your ADR, is called your average daily range, and this is your ATR, your average true range. ADR tells us, on average, what a stock moves from top to bottom on a given day. 1.41%. ATR is a dollar amount from close to close. So first things first, the main differentiating factor between the two, other than this is a percentage-based indicator and this is a dollar-based indicator, is that the ATR takes into account gaps, whereas the ADR is strictly intraday. Both of these are wonderful volatility indicators for you to learn, but they also allow us to set expectations for a trade. JP Morgan is a 1.41 ADR, and we want a 25% move from entry to take profit. Is it realistic to believe that this is going to happen within 1 month? Probably not. Is it realistic to expect this to work in 2 months? Probably not. We all know that markets don't just do this unless you're an SMCI. They don't just go straight up. It's just generally a staircase in nice uptrends. Elevator down, back up staircase, elevator down, back up, scam wick up. You get it. The lower the ADR, the longer the trade is generally going to take. The lower the volatility, the longer a trade is generally going to take. Duration style trades are generally lower ADR and they require more time to play out. Now, the reason why I said different accounts might prefer different types of trades, if you have a larger account and you don't have a lot of time to manage this shit, does it make sense to get into something like JP Morgan where you can reasonably rely on the fact that JP Morgan's not going to gap down 20% because it's a mega cap financial related stock that's incredibly important in the world and breaking out to all-time highs? Yeah, it's probably not going to gap down 20%. So is it fair to say that it's probably a pretty good trading vehicle for somebody with a large account that can reasonably park a decent amount of capital inside of it without running the risk of ruin, meaning blowing up your account? Yes. Absolutely. That's why the very first thing I said when we started this webinar was this is a great cornerstone trade for a portfolio. It's not going to go 1,000%, generally speaking. It's not going to move 50% in a month like some of these small caps, but it's not going to blow you up either. And you can get a little bit more overweight and stuff like this to counteract the fact that it's slower. Now, momentum trades are going to be a little bit different. Momentum, as you can probably tell, are incredibly volatile. Let's look at one that we just opened today, Vimeo. Now, I don't want to get into why we own it, but I'm sure if you've watched our webinar on Stage 2 Breakouts, you're probably looking at this and you're going, holy shit, that's a picture-perfect Stan Weinstein potential Stage 2 breakout. We already bought it, so it's not proprietary. Hopefully it works out now that it's out there in public. But look at the ADR, 5.15. That means on any given day, this thing moves 5.15% from peak to trough. If JPM moved 1.3 or whatever percent, and this moves 5.15, this is almost 4 times as volatile on an intraday basis than JP Morgan. Take into account the market cap, 804 million versus JP Morgan's, like, what is it, 400 billion or something. From a trading standpoint, Vimeo is going to be way more hands-on of a trade. Why? Because it moves faster. So let's use the same logic we did with JP Morgan when we were setting our entries and looking at our take profits as we do with Vimeo. Vimeo is a 5.15 ADR based off of this potential stage 2 breakout. We're buying the 475 break and we're looking to move up to 585. It's almost the exact same distance from entry to take profit as JP Morgan. JP Morgan was 25%. Vimeo will pretend is 25%. What is the difference between JP Morgan and Vimeo on a volatility-based setup? Vimeo moves 4 to 5 times faster. So once again, I'll ask you the same question. JP Morgan trade. Did it make sense to buy 1 or 2 months worth of expiration? No, it's fucking slow. Vimeo. Does it make sense to buy 6 months of expiration on this for a 585 price target? Absolutely not. This thing could hit 25% in a week or two, which is what we think is going to happen. And we can generally plan for this by utilizing these volatility indicators, particularly the ADR. This is a volatile name. So, for example, you're swing trading. JP Morgan back in January, we bought June's. That's 6 months worth of expiration. For Vimeo's, does it make sense to buy 6 months worth of expiration? Probably not. Not saying you can't, but it's probably not. It's probably not the most efficient expiration to go for in this type of setup. You can probably get closer. Doesn't have to be that far out. As a matter of fact, if we pull up the chain, I don't remember exactly what we did. Pull up the chain on Vimeo really quick. You can look at the open interest and the volume on this, by the way. Not endorsing this trade whatsoever, but just to prove a point here. I don't want to turn this into an options-based webinar, but this is an incredibly volatile name, which obviously at 5.15 ADR, you know. But does it make sense to own something at 187% IV? Probably not. For any of you guys that know something, you're either looking to sell theta into that IV, or you're looking to avoid it entirely because the odds of an IV crush type of scenario are huge. Well, to April 19th, which probably would have been the best expiration, but it's also 143% IV. IV rank is negative 2.2, which means this is low over the last year. This shows you how volatile something like this is. Go out to the Julys, and all of a sudden, at very minimum, below 100. And we took a whiff on the $5 calls for July. This is really high IV for something we normally do, but we did a mix of shares and the $5 calls on the July 19th. This is our volume, the 170 contracts on the day. But once again, you can see the difference. In this case, I guess I kind of proved my point the other way, but still, there's not enough expirations to be able to prove that we should have bought the Junes here. But we're not expecting this trade to take until July. As a matter of fact, I think the trade setup that we took said this trade expectation is in between 1 and 2 months. And that's on the safe side worth of expiration. You get to 585. Now, from there, do we go to 761? Maybe, probably. I don't know what the market's going to do. But it doesn't make any sense to plan for a super long trade on something that has all of this beta inside of it. So we go back to JP Morgan. Once again, pull up the volatility indicators. 1.41. It makes sense to plan for a longer trade. And like I said, we've been in this for over 2 months, or about 2 months now, and it's up 100-something%, which, by the way, is not bad. But for most people, they'd probably get bored trading it. So once again, I'm not sitting here shilling. You need to go out and buy these duration style plays. You don't. As a matter of fact, I know plenty of traders that are profitable that don't want to touch anything like this because it does move too slow. But in TTI, we have an entire slew of traders that don't have time to sit behind their monitors all day. As a matter of fact, most of you probably don't have time to sit behind your monitors all day. And so having a trade like JP Morgan on your portfolio that you can reasonably assume is not going to blow your fucking account on a random Tuesday, unless Jamie Dimon slips and breaks his neck, or the end of the Federal Reserve happens, or some crazy shit, you're probably not going to lose your ass on a JP Morgan trade. And when it does eventually hit 100%, which in this case it did for us, it's a completely risk-free trade, and we still have the June, so we still have 3 or 4 months still left on these things, and we don't have to worry about it, right? So duration versus momentum is incredibly important. I think we can look at one more trade idea here that we took that illustrates a slightly higher volatility. Once again, here's Sphere. Now, I do want to point out, for those of you that are newer to trading in general and this idea of volatility and how it might be able to give you an expectation for a trade, not always, but generally the lower the market cap, the higher the volatility. So if you've ever traded smalls or micros, you know those things can move 10, 20% in a single day. You're not going to see a 10 to 20% move intraday usually on a mega cap unless it's fucking Meta apparently or Tesla some random days. But most of the large and mega caps are not going to, it's just not possible to move them that much. There's not enough money available to flow into them, generally speaking. There's always going to be that outlier. But it's the smaller market caps that are generally going to be higher beta. So when you're looking at something like Sphere, for example, Sphere Entertainment, which I guess is the fucking Sphere in Vegas, this is a small cap at 1.52 billion. So we were just looking at Vimeo at 800 million. This is a 1.52 billion. Look at the ADR, 4.68. Once again, it's a very simple setup. All of these setups that we take are relatively simple for a reason. You don't need to be a rocket scientist to draw a fucking straight line and buy on top of it. Just looking for a couple taps here and go, I guess it's going to go up more. But here we are. Is this a momentum or a duration style play at 4.68 ADR? If we shift clicked up from 43.5 to 60, we're looking for a 35% move, and this thing moves about 4.5 to 5% per day. Does it make sense to buy 6 months worth of expiration on this? Generally, no. We have trades in Sphere. We have some contracts, and we have some shares. This trade, once again, just like the Vimeo trade, is a 1 to 2 month hold. That's what we expect to get from 43 to about 60. Probably closer to 1 month than 2 months. We'll see how it ends up happening. But imagine JP Morgan, when we were planning this trade, if we said this thing's going to last 1 to 2 months. That's our expectation. We wouldn't have been able to hold it until today because it didn't really do anything. As a matter of fact, we started in a hole on the gap down with ER. So if our expectation was JP Morgan is going to move 25% in 1 to 2 months, we would have closed this trade already because it wasn't working. That's why this concept of duration versus momentum is so powerful, because not only do you know which expirations you want to capture when you're looking to trade, but it also allows you to build an expectation for the trade. So let's say, for example, you have a 6-month time frame on this trade. The first 6 weeks, if it's not up a whole lot, you're not going to freak out. You're not going to want to close it. Expectations are incredibly important in trading. Also, this is a little bit higher level stuff than what most people are trading like. Not necessarily you, but most people never get past the stage of there's a triangle on the chart. I'm going to buy it. There's a whole slew of things outside of fun chart shapes to understand if you really want edge in the long term. And one of them is this duration versus momentum. Now, obviously, this is going to be a little bit more applicable to swing trading, position trading, and long-term investing than it is scalping and day trading. But this concept of volatility can be extrapolated out to scalping and day trading. For example, let's say you're day trading something like Apple. You know, on any given day, this thing moves 1.67%. So maybe you take that into account when you're trading Apple, that the percentage moves are probably not going to be as big as something like AVDX, which is a name that we're also in, at 2.9%. Maybe this is going to move a little bit more intraday from a day trading perspective. So it can set an expiration for those of you that trade things like orbs, open range breakouts or breakdowns. Maybe you have a general idea of, hey, if this thing moves, we'll say 5%, you have a general idea of how high the top of the day is going to be statistically. See how you can use volatility to help shape the expectation even of a day trade or a scalp. It doesn't have to play out, but it sets an expectation for something. So if something moves on any given day 5% from peak to trough and something's already moved 5%, is it reasonable to expect that day's move is over, at least in terms of highs and lows? Yes. Probably. And then you get to either move to mean reversion style trades or to a different ticker because it doesn't make sense. Volatility is incredibly important, ladies and gentlemen, and hopefully this has opened your eyes. If you don't understand anything, what I'm fucking saying, at least you know that you should know it. And so you can go and Google it or YouTube it or DM me if you have me on Discord, etc. Right? It's an incredibly important tool that can help you set expectations for winning trades. Once again, JP Morgan, I want to point out that we found this trade using a top-down approach. The market environment is more important than the individual stock. Plugging and playing stocks based off of chart shapes don't have the same type of lasting power that we're looking for in these duration style plays. We need to make sure the environment of the actual market is conducive to hold a trade for upwards of 6 months. If we're in a bear market, for example, should we really be buying breakouts? Probably not, especially if we're looking for 6-month holds on these breakouts. But we're not in a bear market. We're in a bull market. So understanding where we are in the market environment, which sectors are outperforming, which industry groups are outperforming, which market caps are outperforming, and then going and scanning and finding the actual stock that we can plug and play in there to capture the market environment thesis that we built allows us to own some of the market leaders, some of the strongest stocks in the market. If you've been following any of our content, this is not the only big name that we're in. A lot of the mega cap names, we're in the meta play, right? We've been in meta since, well, we've been in meta 3 times, but realistically, the last ad, we added in November here, and we added at the all-time high, and you can see we captured the gap up in new all-time highs, and it looks like we closed at an all-time high today. We're in the meta trade. We still have remnants of a Microsoft trade that we bought back here in the November trade. We're in the ARM trade. For those of you either in TTI or in Simple Stacks, we're in AMD. We're in AMD very heavy. Wow, look at that. We've been in AMD for quite a while now, and we actually added a few sessions ago in towards this overheads, not overhead supply, but a consolidation fractal on top of previous resistance area. Just basic technical analysis. If you're in a continuation fractal on top of a previous resistance area, you generally want to be adding into your trade. We got the pop today. We were able to sell for half off at 100%. We have 3 individual positions here in AMD. All of them are free, by the way. All of them are free with varying expirations and strike dates. This is a grand slam trade for us. So if you took it, congratulations. But the reason why I want to show you this is we are in all of the market leaders, and that would not be a doable if we didn't focus entirely on market environment more so than the individual stock, especially because I still see dum-dums asking if we should own things like TSM, which, by the way, not shitting on TSM, it looks okay. QCOM, right? We have QCOM up. What's another one? MU, which actually was a put for us as a hedge, which ended up not working, which is great. But all 3 of these, look at the validity of the uptrends, and then look at ARM, look at AMD, look at NVIDIA. What's one common factor between all 3 of these that the other ones didn't have? They've been leading the market for a while. So if there's one thing you can take away from this particular webinar, it's that market environment matters more than the individual stock. Understand which part of the markets are moving, where financial institutions are moving, then go and find the actual stock, plug and play, capture that, understand duration versus momentum. It's incredibly important for establishing expectations for trades, and will also allow you to maneuver through the options chain a hell of a lot more efficiently. You're not going to find yourself in a super long trade with only 2 months to go of expiration. You're also not going to go buy a fucking leap on a small cap, right? So understanding this is core. Is there anything I'm going to hop on, or I'm going to stay on for about 2 to 3 minutes? If there's anything in particular you want me to go over on the JP Morgan trade or this idea of duration versus momentum, feel free, and I will try to explain it. Give you guys a second to ask the questions. This is this concept for us of turning trades free, particularly in trades that we have a lot of expiration on, is part of the reason why you routinely see us post like 1,000% winners. It's not a farce. We're not like cooking the books or whatever when we do stuff like this, but it's a direct result of being able to, I'll just go back to Discord really quick while you guys are typing. It's a direct result based off of being able to hold these trades really long, because we're in these duration style trades a lot of the time with a lot of time on our side, and we're able to take them free relatively early. Some of these are a little bit older, like middle of February, but you can see Uber was up huge. It is still up huge for us, but you can see kind of the consistency here that we have. We have some huge wins, 1,000% wins and stuff. This is not on accident. I'm not saying every trade is a huge win for us, but it's a byproduct of the system of holding these trades really long, and we're not willing to sell them indiscriminately, right? Part of that is closing these trades at half off. So when we get to 100%, close half and continue to ride. Okay, where can we find the ADR indicator? This is the last thing to answer, and then I'm going to hop off. If you go up here to indicators and then just type in average daily range, this is a custom indicator that a member Mike made for us, but none of this is proprietary. Each one of these is just a separate indicator that you can find here in the indicators tab in TradingView. You just type in average daily range and it'll pop this one up. Once again, this is average true range, dollars, percentages. All right. I appreciate you guys. Thanks for hopping on. Hopefully this has sparked some curiosity in the idea of market volatility, duration versus momentum, and obviously gave you an inside scoop of how we approach the market through a top-down approach.